Good morning, everyone. Just a quick introduction, and I'm going to turn it over to my panel. I am Andy Jonas. I co-run Goldman's global real estate investment banking business. I'm just going to make a few quick remarks, and then we'll start we'll start the panel discussion, then we'll turn it over for questions the last 10 or 15 minutes. A year ago today, there seemed as if there was no bottom to the crisis. There was no liquidity in the markets. There was no view on valuations. There was no idea if your company would survive this crisis. Growth, earnings, acquisitions were all irrelevant. The only focus anyone had on was, how can I survive this crisis? Where we sit today is totally worlds apart, particularly for the group of panelists I have right here who have seen their stock prices on average over 100%, which has considerably outpaced the RMZ index. There's tremendous liquidity in the market, as you heard David say. Over $35 billion of public debt and equity have been raised for REITs. We're beginning to see some life percolate in the asset sale markets. There's a tremendous amount of capital out there looking for opportunities. We've even seen some moderate success with public REIT blind pool, both equity and mortgage REITs. There are, I think, over 12 deals in registration and many more to follow. In addition, since the DDR securitization, we've seen a tremendous revitalization in the securitized debt market. Senior AAA spreads, which a year ago were somewhere between 500 to 800, if you could even find them or measure them. Today, AAA seniors sit at about 125. On an asset level financing, you can do 65 to 70% financing, somewhere in the mid 6% range, which is worlds apart from where we even were 2 months ago. All the key economic indicators have seemed to improving. Housing, retail sales, industrial spending, global economic growth, even the labor markets, we have seen some indications that's beginning to stabilize. Although clearly the main fear is that will these labor markets come back quicker? And that is probably the most important economic indicator for our industry. The other dynamic that we certainly have is what's going to happen with the $1.4 trillion of debt that's going to be maturing in between 2010 and 2012. Many of the questions that need to be answered are, will the money center banks holding this debt continue to extend? Will the government force them to write down this debt at some point and sell, which obviously would create great buying opportunities? Can the equity and debt markets remain this liquid? And will the underwriting fundamentals continue to stabilize? The one dynamic I'm sure we can all agree on is that those companies that are well capitalized and well managed will find the best opportunities. What many of us want to know is, where are the opportunities and in which form? Will we see them? Which companies will take advantage of them? And which sectors will emerge faster? With this esteemed panelist, hopefully we can get some of those questions answered today. How do you see the advantages being public versus private, and what advantage do you have?
Well, I think there are significant advantages in the current market, although it certainly is competitive, as Neil described. The liquidity and access to capital are tremendous advantages. In healthcare, what we see at Ventas is private owners like pension funds and opportunity funds still do have equity in their assets. They're not as over-levered as some other asset types. And so they want liquidity in a large organization that can absorb debt maturity risk, and they still have equity. So we're seeing a tremendous amount of opportunities from that type of buyer. But then the alternative for many of those, from that type of seller, the alternative for many of those companies, though, is to do IPOs. And I think this is a banker-driven sort of IPO pipeline. I don't think most of those IPOs could or will or should happen. And the reason I think that is that the investors have been very wisely discriminating in terms of IPOs. They were, they provided a lot of money in the REIT recapitalization and didn't make the distinctions that I thought they would. But they've been very disciplined, I think, in the IPO and blind pool market. And the bankers, I think, are telling these private people they can go public. They're going to get industry-leading multiples from day one. And what we're telling them is, you're going to get a median or below multiple, you're going to get a new issue discount of 15%, and you're going to pay 6 or 7% fees. And at the end of the day, Ventas can pay you more than that, and we can still make a lot of money for our shareholders. So that's how I think it plays out, at least in healthcare, with a liquid currency that we can provide and an ability to absorb debt maturities.
Remind me not to bring you our next pitch.
Okay, I'm sorry.
Ed, your industry is probably seen as much private investors as anyone, particularly when you look at some of the large transactions that were done. How is this impacting your business, and what are you seeing today? Are we going to continue to see, hotels, a main sector that's bought by the private investors, or will that become more into the public REITs?
I don't know that you'll ever see the opportunity funds leave the hotel sector. The volatility of our world attracts interest in every type of environment, and so I think you'll still see private capital chase after hotel deals. But I do think that when you think about the public-private mix and the challenges at looking at acquisitions in our world right now, one of the challenges that you run into is, I think some of the other sectors have migrated back towards 65 to 70% debt levels. So far, at least what I'm hearing from my CFO, is we're not seeing that in the hotel world. The leverage is far more conservative there. Hotel world's been hit a lot harder, too, from a standpoint of reduction in cash flow and reduction in value. So to some degree, while there's some activity by a lot of the opportunity funds, or there's capital available with opportunity funds to pursue hotel deals, the reality is most of them are hamstrung by the transactions that they did before. And I think a lot of their focus has been trying to decide what's the right decision to make about the deals that they did. We're not seeing quite as much activity or as much competition for the few deals that have come to the street from that part of the world. It's really been more the public capital that's been most active on the acquisition side so far.
Okay. And maybe both David and Neil, you both raise money privately, David, through joint ventures and things that you do, and Neil, in your funds. How has that changed? And obviously we've seen, we hear how difficult it is to raise private capital today. How difficult is it? Clearly, we saw many public companies sell out. CEOs raised funds. Clearly, this is a completely different dynamic today. One, how difficult is it to raise money? And two, how the terms have changed? And we've seen announcements from very large funds like Adi and others who said we're changing our strategy and how we put money to use going forward. So maybe you both can elaborate on that for everyone.
I'll start. Institutional capital in our business has become plentiful. The world has changed dramatically in a year. We are getting frequent inquiries about putting out capital. These institutions that were absolutely frozen a year ago now are tiptoeing back into what we call core real estate, and they want a strong operating partner. They like having a public company as, if you will, a service provider or an operating partner, and somebody that can co-invest with them. The separate account model is back in favor, especially with a lot of large pension funds and life insurance companies. When there's a lot of conversation about cap rates coming down, and they have, what is not so widely discussed is the first question these institutions ask is, what market is the asset in? They want primary markets. They want New York, they want Boston, they want San Francisco. Nobody's asking us to go buy an asset in Hattiesburg, Mississippi. They want those primary markets. Secondly, they want those Class A+ assets, and that's where the cap rates are under pressure and coming down. And third, there still is strong underwriting discipline. They are underwriting the NOI. We are underwriting NOI much more carefully than we did in the past. So yes, prices have firmed up, but it is for the best properties in the best markets, and there still is a strong focus on exactly what that cap rate is capping.
Neil?
Well, it's kind of interesting in terms of private equity raising capital right now. First, many of the private equity firms have a lot of capital that they raised back a few years ago, and we haven't invested that money. because nobody has really put a lot of money out to work over the last year and a half or so. So there's no question that it would be hard raising private equity real estate money opportunity fund right now, because the institutions are nervous and the pendulum always swings so far in every direction. In the early 90s, the REITs started raising a lot of money. By the mid-90s and throughout certainly through the 2000s until the last couple years, the opportunity funds were in a position to raise huge amounts of capital. Now we're out of favor because the last funds that anybody did are obviously not doing well. But that pendulum will undoubtedly swing, as it always has, from one side to the other side. As I mentioned earlier, that may well occur if REIT prices get very high and opportunity, so you're investing in a REIT, it'll be expensive. And conversely, opportunity funds can take advantage of more leverage and do more opportunistic kind of things, not worry about current earnings, things like that. So it'd be very hard to raise money today, there's no question, but a lot of us are not in the market because we still have a lot of capital that we have to invest. By the time we get it invested, we'll see what the market looks like in a year or two. Let me put it this way. I'd rather be a public company today because the capital markets for equity are far greater for the public companies today. There's absolutely no question about it. Don't misunderstand me. But the private equity firms, most of them have a lot of capital that was raised and has not been invested yet.
Right. A lot of capital, I would say.
Andy,
The advantage.
Andy, maybe just one other point to throw into this is that as you think about the public world versus the private world, there are two distinctions that at least we've been drawing that I think have some validity. The first is that we've heard a couple different times about the pendulum swinging. And I think one of the biggest pendulums that swings back and forth is the perception of the value of liquidity. I think there were times 2 or 3 years ago where I would be at meetings of private investors, and they were all feeling very good about where their values were versus where our values were. Well, we now know that the public market was ahead of the private market. And those folks that were caught up in those investments really never had the opportunity to escape those investments if they wanted to. I think we're back in a different part of the cycle now where liquidity is more highly valued, and I suspect that will help the public markets for the next few years. The other point I would make that it is sort of a distinction within the REIT world is those companies that are able to rely on public debt versus secured debt for the bulk of their balance sheet. And the reason why I think that's important, especially in those sectors that are more volatile, is that when you think about it, if you have to go out and finance properties today and use secured debt, and you have a perspective that rates are not necessarily going to go down in the next couple of years, you'd like to run that debt out for a 7 to 10 year period. The problem is that if you're financing today, you're financing off of fundamentals that are weaker, you're financing off of cash flows that are weaker, and so you're essentially locking in debt on properties, and you're going to pay a big price to unlock that property if you choose to refinance that debt in the future. Those companies that can access the public market can both lock in debt at lower rates for longer periods of time, but especially in my world, when our EBITDA doubles, and it will, I just don't know exactly when. At least I got the commitment it'll get there, right? But when our EBITDA doubles, I'll be able to access a lot more debt, and I won't be paying a lot of prepayment penalties in order to pay off the debt that I may have put in place last year or this year. In some of the other sectors, that's not as big of a deal because they're not quite as volatile as my world. But certainly in any of the sectors where you see material movement in cash flow, either on an asset-by-asset basis or in the whole company, the approach that the company takes to financing can make a big difference in terms of their ability to access their enhanced value and their enhanced cash flow 2 or 3 years from now. But it's worth watching because it really will make a difference in terms of performance in the long run.